Well, hello everyone, David Blackborrow here, Senior Advisor at Beulah, coming to you from circumstances which aren't ideal, stage 4 isolation restrictions, but we still feel compelled to maintain some kind of video interaction on a regular basis with investors. Now, earlier today, I had the opportunity to speak with our Managing Director and Head of our Investments Committee, Christian Ryan, to talk about reporting season, which concluded on the 31st of August. Now, this is really an opportunity to look back and see what the downstream effect is of all this COVID disruption as it materialises on the balance sheets of these companies and affects earnings and our predictions. So we get into discussion about some of the winners and losers of the stock market, both here domestically and overseas, and what this means from a point of strategic asset allocation in the future. We also touch on an important area, particularly for retirees, which is fully franked dividends and income distributions, which historically have been quite high, particularly from the major banks and financial institutions here in Australia. One might argue that for the last few years or even decades, they have been very good producers of income, but are those days past us? What does it look like in the future, and will it ever normalise again at those rates? So I hope you enjoyed the dialogue that we had, and we hope you find it informative. Of course, if you have any questions that come out of this video, please feel free to reach out to your relevant advisor. Thanks for joining us. Justin, thanks for joining us. So I was just hoping maybe you could talk to us a bit about reporting seasons, the outcome. Let's start with the domestic markets. How did things fare?
Thanks, David. Look, the reporting season, as many probably anticipated, was going to be quite mixed, quite interesting. Who knows what was going to happen? Certainly, most people were expecting, given that reporting generally reflects what's happened in the past, the profit, dividends, all the issues that have come across because of COVID were all coming out and giving us an update on that. The question was really how bad, or how bad exactly was it, or in some cases, how good was it? So look, just a couple of key stats, I think, in terms of the figures was, profits were down, down about 20%, from last year across the board. Dividends were down by nearly 30%, across the board. Banks certainly were pushing that number higher. But I suppose actually what was probably a theme out of it, the dire sort of forecast that I think people were really perhaps expecting back in March and April about what may unfold, probably didn't really eventuate. So we did have, probably a number of stocks that upgraded, but at the same time, a whole bunch downgraded. What was hard, or what we were looking for from the reporting season, was what was being said about the future and what was looking forward. And probably given it was August, and particularly being here in Melbourne, it was probably for a lot of companies have not provided guidance, going forward. And to some extent, rightly so, it's very difficult in a lot of companies to actually predict what was going on, depending on what happens with, the coronavirus. So they were in terms of the numbers, if you like, David, were pretty grim, probably the worst that we've had. But remember that the market's all looking forward all the time. And so from that, there were actually, I suppose, 4 key themes that I would describe from the reporting season that were, I think, for us to really focus on. One is stimulus that was provided through JobKeeper and everything else was spent. So we've seen a lot of the retail type stocks, JB Hi-Fi, Bunnings, a lot of online stores in particular, their volumes, going through the roof. The second one, probably the bigger guys, the bigger got stronger, the weaker got weaker, if you put it like that. And it meant that we've seen a lot of in relation to that, we've seen a lot of companies, if they've been able to recapitalize, raise money, restructure, they're actually getting themselves into a much stronger capital position. Now, that might be at the sake of dividends and paying out dividends, but there's a lot of companies that are getting their balance sheets, in order, or trying to get it in order through this period. It was pretty clear, and I think everyone's very clear, both globally and here in Australia, that digital and software and tech type companies accelerated, out of the back of this reporting season into and out the other side. So anything that's digital, particularly when people are stuck at home, obviously in Melbourne, we're still able to trade and buy stuff, all over the wherever we want. And that was pretty evident through the reporting season that a lot of the good tech companies did a pretty good job. And probably the fourth one, the one that we've actually spent the most amount of time on, because I think it's the one that has the most question marks about it and still is around commercial real estate, in particular markets like office. Retail property has probably been on the nose for quite some time, and there's pockets that are actually all right. But the biggest one that's probably been flipped on its head, more around the questioning going forward of what happens with the office market and what actually really happens and what actually drives the value of them going forward. Has the traditional model of just owning good, offices and getting good lease payments from tenants in place, or, is it gonna be an absolute disaster? So the one that we've actually, on a contrarian basis, been spending most of our time trying to look at the opportunities in the space is commercial real estate, because for a lot of REITs in particular, a lot of their asset values haven't improved dramatically, since the bottom of the market. We've seen some, but we're still seeing, since year to date, since we're still down 20, 30, 40, in some cases even 50 to 70% down in share price. So is that a buying opportunity, or does it just mean that there's still a lot of unknowns in that area? So they were probably the key themes out of for us, and figures. It was a really interesting period like we've never had before, where one, you sort of knew that was going to be bad, in terms of the numbers, but what we were looking for was what was it looking ahead going forward. And to be honest, I think going forward, what can you take out of the reporting season here in Australia, or even globally? Your first question you got to ask is, what shouldn't I be in? What is it that I shouldn't be exposed to is probably just as good of a decision as actually, well, what should I be in? Because there's certainly a lot of stocks that still haven't been, still hurting, through this COVID period.
So there's been a lot of commentary around the US. We've seen the NASDAQ continuing to pretty much be immune from COVID. In fact, it's hit record highs. In fact, there's a chart just here on screen which shows that the S&P 500 has, if you take out those big, large Facebook, Amazon, Google, Netflix, was really carrying the S&P 500. Are valuations still realistic on some of these tech stocks? Is this a place where you'd still deploy your cash and find as an attractive area, or do you think this is potentially overvalued now?
I mean, stock valuations, and we've seen it, was it just yesterday, the day before, last couple of sessions in the US, those tech type stocks have been hit pretty hard. I mean, they've rallied very, very strongly. And look, across most portfolios of clients, we've got a good exposure to those, big blue chips. I think the argument is around, people see them as, high growth, and they're high growth companies, but also in the event of a downturn, they were the ones that also held up the best and accelerated out the other side. Mm-hmm. So at the end of the day, if you're a long-term, sort of investor, these types of stocks will be just long-term, your blue chip, mega structural growth type of stocks that will continue to probably do well. Now, yes, there'll be times when they'll get hit, quite hard, but at the end of the day, they're probably growing at 20, 30, 40% a year, which means that, you're going to get valuations that feel like, quite high. So, with interest rates remaining low, and there's just, you can see, like, there is a structural continued shift of people using technology. And if you've got the best technology in the world, people aren't going to stop using it no matter almost what happens in the world. I think the biggest risk to a lot of these companies is whether they get almost too big, and we're starting to see governments impose different types of, whether it's tax laws or privacy laws or any sorts of stuff. That's the biggest risk, I think, to any of these companies, that they become so, so big and so important part of life that they get, somehow strangled hold by government, and social, types of issues. But at the moment, I think if you look at a portfolio and you look at where you want to position, as I said, that the first step you want to take is what shouldn't I be in, but the second step, technology and variations of technology type companies, I don't know, just aren't slowing down. It's got to be, and certainly what we've done through portfolios is try to make sure you've got a good core, exposure to technology type businesses.
Okay. A question which has been raised as well from some investors that sit across their portfolio and look at it regularly. Retirees obviously have really had a good 20 odd years maybe of that halcyon era of the banks, the financial sector paying 5-6% yield, and there's a bit of a tension to say, well, is this, what does normal look like in the future with dividends being cut, and you're trying to generate an income to sustain your those expenses, or a passive income that you're drawing from your retirement balance? Does this mean there's a redeployment to infrastructure or other sectors, or are the banks still a best place for income?
No, I think income, and particularly from particular segments in the market, is going to be really hard. If you just think about it, companies have to use this period and are using this period to preserve their businesses. And the first thing they do is, what cash do I have? And one of the parts they can control is not paying out dividends to preserve cash. So the reality is, for banks, is that particularly with home loan deferrals and unemployment, all this sort of stuff, is that they are protecting themselves, and they have to. It's prudent to do so, and therefore you would expect that to be the case, maybe for the next year or two. I'm not really sure. They'll just have to keep protecting themselves until the economy and things get going again. I mean, we might be surprised. For example, part of we've been surprised at how much particular retail type stocks have actually done a pretty good job. So where people won't spend, in certain areas. So, for example, Australians spend about $25 billion a year in travel. So even if you include unemployment at its highest rate, there's a whole bunch of money there that's not being spent overseas, is now got to be being spent on, like consuming online, all that sort of stuff, and maybe buying better houses, interest rates so low. So it'll move to a different segment. I mean, at the moment, the latest update, in terms of from an economic sort of contribution point of view, Australians are probably what they call the savings ratio to their income is at one of their highest level that it's been since the 1970s. So, and that makes sense. People aren't moving around, not spending as much, and therefore inherently saving money. So what might seem on the surface, gosh, what's going to happen there? It's now, I reckon, getting moved to these other areas where people will probably spend. I just think particularly it's going to be difficult with the sort of this lagging effect of they're sort of almost a quasi, protecting the economy along and helping people with their cash flows. So I can't see income much coming from them. And where we need to, if you're looking for income, and where we feel best to find income, is probably those really conservative, infrastructure, electrical type of assets, and industry and segments that are probably likely to hold up okay. Now you're not going to get maybe a 4 or 5% dividend. You might be down in the 3s, so you'll get something. So the challenge then for a lot of clients is, I think you've then got to change your mindset a little bit and say, well, there are some opportunities for growth in particular areas. If we do get capital growth in those areas, then sometimes we've just got to take your profits and use that as income. Now that's quite suitable for a lot of clients that are probably older, that have got, they're in pension phase, the tax is less relevant. So, but I still think when you're looking at an investment, the cash flows from that company and that investment is still paramount as to whether that company is going to be any good. It's just a question of how much and if they're going to pay it out. And I suspect in general, in the theme going at the moment, there'll be less payouts going on for the foreseeable future as people just restock and rebuild probably over the next couple of years, and then maybe then push those back up after a little while.
So, Christian, our portfolios, particularly for this quarter, or the last two quarters, but particularly this quarter, have stood up really well by comparison to peers in the same space, but also against the index on a risk-return basis. What have been some of the standouts in the portfolio? With the news from reporting season, is this a case to take profits and redeploy, or are you simply happy to maintain what we've got?
No, so through April, in the COVID period, we did make quite a few changes, structurally taking advantage hopefully some of them. It wasn't in a silly manner. It was sort of quite in a, hopefully in a deliberate manner, which has meant certainly for the month of August, July and August have been quite positive, for the portfolio. Out of reporting, and what we did, we continued to keep a strong, tech, flavour and healthcare structural flavour to that. So what worked through the, I suppose what was really positive out of the reporting season for us was stocks like, we've got Afterpay, which has certainly been in the news and has done extraordinarily well, probably well beyond, what we ever thought would occur. But there's certainly, that is a structural shift that is occurring where that type of payment system and method is actually building a lot of confidence to compete against Visa, MasterCard, credit cards, that sort of thing. So I don't think that's actually slowing down. Valuations might seem pretty silly at the moment, but as a long-term thematic, I think that financing of that type of transaction is probably got some long-term trends, about it. Probably the other areas of online or tech type businesses that we've had in the portfolio, Xero, which is the accounting software, has continued to progress really well. Realestate.com.au, although we've got some concerns here in Victoria with the real estate market regarding opening up and leasing and doing inspections. That type of stock has actually progressed pretty well. Actually, and we've had Seek as well in the portfolio. Employment situation. It hasn't been. It's been off a little bit negative, so it's probably on the downside. Not great, for us. We've actually held pretty good positions in CSL, which is a big healthcare company. But the other ones we had pretty good positioning is BHP, Rio, the miners. Miners is probably another, going back to an era where they continue to spit out really great, cash flows and profits from what they're doing, and that should, continue to hold up. I think pretty well. Probably the areas that didn't go so well, or certainly probably still struggling. We have a small positions in oil and gas. In Oil Search and Woodside. Like, again, if you can clearly see the structural differences between, financing, tech, healthcare on one side, and then oil and gas on the other. Now, there are times when you can be owning oil and gas stocks like in a big way, but our positions aren't that particularly big. So we haven't, it's neither here nor there across, most portfolios, but they didn't go particularly well. I think most people were disappointed in Telstra. I thought out of this whole COVID type of environment that they would be better positioned, out of this, but it's sort of one of those perennial ones. You think that they might be heading in the right direction, and it sort of hasn't. We're still holding it, but it's certainly out of this reporting season didn't perform particularly well. Actually, what was interesting, we actually, in some portfolios holding James Hardie, so recovery in the housing market overseas was actually pretty good. So that's actually been performing quite well. Actually, one of the ones that probably for a lot of clients that we hold in portfolios, which certainly hurt us a bit through when COVID first hit, with our what I call our private capital, our debt investments with Metric Credit Partners. For most people, for most portfolios, you would have seen, those unit prices ticking up, back to its net tangible asset value, especially MXT. It's now trading close to its $2 value. So we've seen a really great appreciation of the price back in it. We didn't sell it down. There's probably a time there where people are going, geez, what's going to happen? There's going to be lots of defaults in loans. But these guys are great. They haven't missed a beat. They've had no defaults in their loans. You know, you would see steady levels of income just keep paying each month from all their loans. So what we've seen from a share market point of view is, you know, these types of investments where they once were $1.50, $1.60, and now getting back close to their, you know, $2 mark. So that was really positive because you could see that the income profile of the holdings was really good, and they kept telling us that no loans are defaulting, you know, no one's in arrears, they're all really happy, they're getting paid on time, but the market couldn't see it, and they just kept, you know, pricing it down. Well, as confidence comes back, the market just keep pricing them back up. And even with our Qualitas holdings, you know, Qualitas still trading below its NTA. However, again, regularly speaking with management, the income profile is still there, actually being really, really conservative. Again, speaking to these debt guys that are specialists in areas, the number one thing that they always say is, and I would probably echo that as part of this strategy going forward, it's more half the time about what you're not in versus what you're in. And they have kept away from hospitality, you know, travel, you know, those sort of really bad areas that even now you sit here and say, look, there'll be opportunities where you might buy particular stocks, but, you know, structurally you're sitting there, you just don't know really where that's going to land. I think it'll be okay. You know, there's probably opportunities where things like we still own Sydney airports, you know, the airports will get back to as core infrastructure assets, will get back to being great, you know, great companies, and they're still quite at depressed prices. So that's been really positive that, you know, fundamentally, even though the markets were pricing some things we just couldn't understand, they're gradually just getting back to where they should. So we're getting some nice, better capital appreciation out of the portfolio than we would have, you know, previously. And probably, look, the last comment I'd make, David, just, you know, out of all that is where to from here, you know, for all, you know, what are we doing differently, or what should we do going forward? Look, I think it's still the case is that if you want to get growth in a portfolio, you've got to stick to predominantly these structural growth types of areas, you know, IT, you know, healthcare, and just some of these conservative, even just some of the retailing type, even like Wesfarmers and Woolworths to an extent. You can't, food, you know, and even, you know, renewable energy and infrastructure. Like, there will come a time when this world will sort itself out, and those core, clean, understanding businesses will actually perform pretty well. So look, we're not making dramatic change. We made quite a few changes through the sort of April, May, and June, and now we feel like we're just letting that ride, you know, for the moment.
Very good. Okay. Well, thanks for your time, Christian. You know, I hope maybe we will do this again in the same room at some point, maybe towards the end of the year, and give people a bit more good news. Thanks for your time.
Thanks, David.